Hey traders, want to unlock consistent Forex profits? Today I'm going to break down a powerful strategy using the Moving Average and Commodity Channel Index, CCI. It's perfect for identifying those golden trading opportunities. First up, the Moving Average, or MA. This indicator smooths out price data to help you see the overall market trend. I like using different periods like the 50-day and 200-day MA to check both short-term and long-term trends. Now let's talk about the Commodity Channel Index, or CCI. The CCI measures how much the current price deviates from its average over a set period. If the CCI is above plus 100, it suggests the market's overbought, potential sell signal. Conversely, below minus 100 indicates oversold conditions, potential buy signal. So, how do we combine these two? For a buy signal, make sure the price is above the MA, showing an uptrend, and wait for the CCI to cross above minus 100 from below. This signals emerging bullish momentum. For a sell signal, the price should be below the MA, showing a downtrend, and the CCI should cross below plus 100 from above, indicating emerging bearish momentum. When to exit? Consider closing your trade when the CCI moves back into the neutral zone between minus 100 and plus 100, or if the price crosses the MA in the opposite direction. This strategy offers trend confirmation through the MA and momentum insight via the CCI. But be cautious. Sideways markets can produce false signals. Always use proper risk management like setting stop-loss orders and position sizing. Thanks for watching. For a visual demonstration and deeper dive, check out the full video linked below. Happy trading!